How you doing, everybody? It's January the 17th, 2010. Beautiful day outside, and it's about 20 minutes past 2 in the afternoon. And I didn't make a posting yesterday, and the reason I didn't make a posting, you have to thank Crocodile Jim for that. Jim, thank you very much for the email. I do appreciate it very, very much. The article that you referred me to, the survey, fascinating, absolutely fascinating. I've been doing these postings now for a good long time, and well, maybe it's about a year. It seems like a year to me. I mean, it's probably not, but it seems like a year to me. And I've been rabbiting on about NAMA and about the massive impact that NAMA is going to have on our society, and about that we have only started to enter this property bubble, this collapse of this property bubble, and the whole banking crisis, and how central it is to Ireland's future and the impact that it's going to have. And all of a sudden, you know, I'm saying this because, like, I'm not an economist, I'm an historian, and I'm trying to read between the lines of all the economic data and facts that are thrown at me. And all of a sudden, a professor of economics from UCD, from University College Dublin, he does a report, a 30-page report on this, and all of a sudden, like, it's like a eureka moment. It's like a holy moly, like, this is what I've been saying. And you know, okay, some of it I haven't been saying, but about 80% of it I would agree completely with, you know, what this man's saying. Like, it's just a wonderful insight into the whole thing. And like, this man, this is his forte. This man's, like, as I say, he's a leading academic, and he just dissects it all and takes it all apart. And so what I'm going to do is I'm going to refer, I'm going to talk about a couple of things. Now I mightn't get them done, because I mean, I have to try and crush down a 30-page report and a couple of, you know, a couple of minutes talk here. And so what I've done is I put the link up to the report, and then what I'm going to do is I'm going to take a couple of points that he deals with in the report, I think, that are central points. And then what I'm going to do is I'm going to read his little conclusion, which I think is quite prophetic and quite concise and to the point. And so that's what I'm going to do. Okay, so I might be able to do it just in one, so I might have to flip over and do a second little speech. So I want to try and keep this short. I don't want these things to be going on forever. I think I might do that. I might just do 2 5 or 6 minute little speeches rather than do one big long thing. Anyway, we see how we get on. The first thing he raises, and it's something that I've been going on about. By the way, this man's name is Morgan Kelly. Or he's a professor of economics at UCD. And what he says is, basically, there was one of the problems was that there was one model. In other words, that the whole Celtic Tiger stroke credit bubble was based around one thing. It wasn't based around a group of things. It's only based around one essential thing. All right, and that is property. Now, that's not quite true, because the stroke property, there was another element of it, equity. You know, shares. They also went through a bubble and collapsed, but they have built back up again, because it's highly speculative, and generally speaking, ordinary people in the street and a vast swathe of society do not involve themselves in buying and trading shares. So he's just talking about this from an ordinary citizen's point of view. How is this going to affect the ordinary citizen and the people at large in society in Ireland? And as I say, okay, well, let's accept that what he's saying is correct about the one model. The one model is the property model, and basically at its core is you've got three elements. You've got the government, who presided over all of this, and then you've got the twin elements of the banks and the property developers. And the banks, the primary purpose of the banks is to loan money, and the primary purpose of the property developers is to speculate and develop property. That's what they are. And the primary purpose of the state at the top is to make sure that nothing is done that's going to endanger the state or the future. We give them, you know, our sovereignty to look after us. Anyway, so these three bodies all failed. Okay, they all failed, and they're all in deep crisis as a result of that failure now. All right, and obviously the banks failed, the property speculators failed, and in turn the government failed. to monitor the whole thing, because it was their responsibility to monitor it all and to make sure that it didn't get out of control and to get a grip on what we're talking about. He says, if you think about this, just think about this, which is true. In 1987, all this basically started. And what happened in 1987? In the time, in and around that year, our total bank borrowings of all of the banks within the state approximately was 60% of our GDP. It was actually less. That's what it was. In fact, I don't think it was 60%, but he said it was 60%. The figures I get are about 40%, but it doesn't matter. So in other words, they were well within the parameters of us dealing with a total collapse of the loan book of all the banks. Okay, so if a worst case scenario came about over a period of 4 or 5 years, we could have dealt with that problem as a state, as a nation state, very, very easily. Okay, and then what happened was, from 1987 up until 2008, it grew to be 320 times, sorry, 3.2 times. It grew to 320% of GDP. Okay, which is, again, it's debatable, but at the moment, it stands at 690 billion euros is what the total amount of our indebtedness, our bank indebtedness, is to the external world. Now, we don't know how much of that is involved in property, but if we assume the normal assumptions are around about 50 or 60% of that would be involved in property. So we're talking about between 350 and 400 billion. 350 and 400 billion euros is involved in property loans out to the various people, the speculators and the individuals within the state. And our GDP is this year is going to be 168 billion. So he's about right. Okay, so it's somewhere around that figure, somewhere around 3 times that, 300%. All right, so that's what's happened. So you can see where the credit bubble went. It went from a small level up to a huge level, and it's cracked open and broken open. All right, so I'm going to break off this now, and we'll deal with the rest of this, and then we'll do his little summation. Okay.